All right. Good day, everyone, and welcome to today's webinar brought to you by Clarity Tax Law. My name is Akwa, the National President of the Ibom State Association of Nigeria, AKISAN USA, and this is a second in our series of webinars to help educate and inform our general membership with respect to different areas. The last one we had last year was on nonprofits and how to run one effectively. And we're hoping that we'll have more and more of this over time. If you have any questions for us or you'd like to contribute, you can send us an email at president@akisan.org, or you can call me at 404-276-4267. And I prefer, if you don't mind, WhatsApp text. Our website is akisan.org. Today's webinar is titled Tax Strategies for Entrepreneurs, and like I said, is brought to you by Clarity Tax Law. And the presenter today is Mfon Etukeren of AKISAN Metro Phoenix. She is the lead attorney of this firm, which provides services in the area of business strategy, immigration, tax strategy, and estate planning. Before we get started, I would like to ask, if you've not already, invite your friends and family. This will also be recorded and uploaded to our YouTube channel so that you can also either watch it again or again share with your friends and family. Before we go into the webinar proper, I would like to read a brief bio of the lead attorney, who is also today's presenter, Mfon Etukeren. So bear with me, please. All right, so Mfon Etukeren is a tax lawyer with over 20 years of experience in corporate America in various capacities. She has published articles in her industry with multiple journals. From working with multiple Fortune 100 companies and large private equity firms, Mfon has seen how businesses make money yet pay less taxes. Clarity Law helps entrepreneurs maximize the benefits that the Internal Revenue Service tax code and rules provide to business owners, while helping them keep more money in their pockets. So without further ado, I would like to welcome Mfon Etukeren to present the webinar today. Thank you.
Thank you, Mr. President. Let me share my screen with everybody. Good afternoon, good morning. My name is Mfon, of course, as Itoro mentioned. And the purpose of today's webinar is to, let me share my screen first before I dive in. The purpose of today's webinar is to give entrepreneurs strategies, right, prior to starting out in business, is to give them strategies for success. So from working in the corporate sector, I have found that there's a certain way that successful companies do things, and there's a certain way that successful company owners do things, which is essentially what entrepreneurs are. So I'm just going to walk through a few things that I'm hopeful will be helpful for everybody. Okay, so that's a little bit about me. I have this, I have this belief that if you're making under a certain amount of money, you should only pay taxes if you want to. Now, I'm not saying that you should evade, but I'm saying that it is possible in the tax code for you to get the maximum benefits such that you may not really have to pay any taxes. So that's what I've seen from working in the corporate sector. So we're going to cover four main topics. Like I said, this is for entrepreneurs. So for those of you that are more seasoned, you've been in business for a long time, you may find this to be a bit of a refresher, but if this is for entrepreneurs. I have been working with a lot of entrepreneurs lately, which is why this whole thing came about. And I found that a lot of entrepreneurs don't have the capital, they don't have the resources to hire somebody like me, to help them out with an issue, right? Or somebody like, say, my mom, who may be starting out a business, somebody that looks like my mother doesn't have the resources to hire somebody like me to help them. I'm a tax lawyer, as Itoro mentioned, right? I had undergrad in international finance, worked in accounting in California, worked at PG&E for some time. And then I went and I worked with the IRS before that. So, been in and out of tax and accounting. And after that, I went to law school. And then I went and got an additional degree because 2 wasn't enough. But as a lawyer, if you want to specialize, you get what's called an LLM. So I got my LLM in taxation. And my taxation focus was for this. I went to Northwestern, and Northwestern is a very corporate heavy school. So it's really focused on corporate taxation. And I thought that would kind of pigeonhole me, but it didn't, because what I saw with corporate taxation is you also get to work with large companies. I work with only Fortune 100 in my entire career, with the exception of the past few years. I've been working with some mid-level companies in California, but large Fortune 100s and large private equity companies. And what you see with large private equity companies is they do things completely differently. So I got that experience, and I realized that a lot of people that start out in business don't have either that insight, or they don't have somebody that will give them that insight. So here I am. So we're going to be learning about pre-business preparation, entity setup, how you can choose one that's right for you. And then we're going to go over IRS red flags and audit triggers. And I want to go over this because sometimes when people start out in business, for new entrepreneurs, you just start out and you may not take these things into consideration, but the IRS loves nothing more than a messy taxpayer. If you're messy books, messy taxpayer, they're going to be like, you can't take that. You can't take that. You did this wrong. And even if you're not messy, if you do not document properly, which is kind of goes to the messiness, if you don't document properly, then it's just like the best field day, right? So that's what they love the most. That's what I don't like the most. So I really try and help my clients. I handhold them through the process of kind of cleaning up their books and making sure that they have everything that they need, so that in the case of an audit, because I wear 2 hats, I wear the tax hat and I wear the legal hat. So I put on my tax hat with the tax rules, and then I take that off, or sometimes I just leave it on. And then I also put on my legal hat where I'm like, legally, how can this pass muster, right? So that's what you get with the tax lawyer. And then we're going to go over some strategies. So the first, this is just a quick agenda. We're going to cover differences in thought between how 1% versus how we do business, normal people. And then what you need to do before you even start your business. Of course, entity setup, red flags, and then strategies for keeping more money. And then on the right are the benefits that I want you to get out of it, right? Starting off on the right foot, insight into how the companies that I've worked for, how I've seen them do business and how I've seen their owners do business. Because sometimes when you get a return, I remember I was filing a return it was a retired law firm partner. So he was making maybe like only about 2.5 million or 2.1 million. But I noticed that he owed like $175. It was very startling to me. And I just was like, how can you make that much money? In my mind, I thought it was that much money and owe so little. And so I started seeing the strategies that were being implemented. And I'm like, interesting. So we're going to go into some of that today. So first topic, entity setup. I would encourage you to drop your questions in the chat. Like Ithora mentioned, from time to time, you see me looking at my screen. It's just to see, I have another screen. It's just to see what questions are in the chat. That way I can make sure that everybody's question is answered. Okay. Thank you, Ithora, for that information. Okay, entity setup. So let me first go into the mindset, what happens from what I've seen in practice. So this is how we do business. We're a taxpayer. I'm the taxpayer. I have a lifestyle that I'm living, and I have a business that I want to start up. Now, what we tend to do is we tend to say, okay, I'm living this lifestyle, but I have this business. And, sometimes a business tends to take precedent over our lifestyle. And this is the bit of the uniqueness with Clarity Tax, is because I take what I've seen rich people do and I put it into operation for the average person. And I focus specifically on entrepreneurs. Now, if you have a bigger business and you have international operations, because my specialty background is in international tax, I've been doing international tax since 2013. So my specialty with other types of tax, thrown in, but it's mostly been international. So all those international tax questions and nuances, filing your FBAR, FinCEN, owning property, FATCA, triggering extra additional tax, just ask me those questions. Go ahead and drop them in the chat as well. So anyhow, taxpayer has a lifestyle that's they like to watch TV, they like to go out to eat at certain places, they like to wear certain clothes, whatever it is, they have their lifestyle and they have their business. Now, normal people tend to say, okay, I have a business. Now I'm just, these things got to give way. I got to concentrate on my business, and they focus on their business, which is nothing wrong with that. Now, what actually happens when you start looking at the returns of these uber rich people? What they do is they say, have a lifestyle, have a business. Neither of this is going to give way. So let's see how this business can fit into my lifestyle. And guess what they do? They now begin to get the benefits of both while still operating their business in a way that they want and living their lifestyle in a way that they want. That's why you wind up having things like trust fund babies, right? And that's why you wind up having people that, are into certain businesses. Now, because this is recorded and it's going on YouTube, I don't want to say too much, but is there a way to pause the recording? Vittorio?
Yes, give me 1 second.
Okay. Actually, no, it's fine. We'll just include it. It's fine. Okay, so that's what you really see. You see top earners and normal people wearing completely two different hats. So what CTL, Clarity Tax Law. So what I've done is I've sat down and I've observed all this because I've been part of corporate audits and so on and so forth. And I'm like, okay, let's see how the average person can do the same thing as a Fortune 100 owners and get the same benefits. So with that, well, that is the mindset. And so before you even start off, what do you want to know? What do you want to do before you even start off in business? First of all, you want to sit down and do what I call a write out your lifestyle. Now, why? Because your tax strategy is dependent upon your lifestyle. Remember that example we talked about, right? You have a lifestyle, you have your business. So you got to write out your lifestyle, because your lifestyle will now determine how you're going to run your business. Now, that's not the average way of doing it, but that's how it's done when you start seeing large rich people returns. Let me give you an example. So say, for example, you're a photographer. You're a photographer, and on your own, you love to travel. You take pictures of everything. Let's just say you like traveling to take pictures of butterflies. You're a photographer. And you want to maybe expand your photography business to include other things. So you have your social media page, your advertising on your social media page, so on and so forth. Pandemic hits. Nobody wants you coming into their butterfly garden, right? Because they probably had COVID, and they're just like, your butterfly gardens are closed and all this other stuff. Now, you still need content. You still want to expand your photography business. Now, this example is just coming off the fly. I'm going to ask some of you all to, at the end, we're going to go into live strategy as it relates to your individual businesses. So that's why this presentation is going to be very kind of succinct. Now, if that person that was a photographer realized that now they can't go and do their butterfly gardens, they want to expand into, doing different types of photography, maybe, let's just say national park photography. They like to travel to national parks normally, not to take pictures of butterflies. So that's their personal travel, not their business travel. Now, if they realized that if they just put together a strategy for how they can now turn their personal likes, personal desires into business strategy, then that national park travel that they like to do, 3 times a year just for fun, we can now create a business strategy out of that, right? Of course, there's going to be legitimate business things you will have to provide, because you can't just be, lollygagging and just doing it just to expense, but you have to show legitimate profit motive. But mind you, you're trying to expand your photography business. So what I make clients do is we document. Now, tax hat, legal hat. That's the legal hat coming on, because I'm like, what does the IRS love? They love seeing no documentation in addition to messy books. So we document. So I make you put together a plan of what service you're going to provide, so on and so forth. And you've now kind of tweaked that lifestyle that was your personal travel. Now it's become something that is legitimately a business expense. So before you even start off in business, I like clients to do what is called, I make them do a lifestyle plan. Plan out your lifestyle. What do you want to own? Where do you want to go? Where do you want to eat at? What kind of lifestyle do you want to give your children? So on and so forth. And then we now see how we can merge the two of that, obviously in a legal way that dots all the I's and crosses all the T's. Okay, fantastic. Okay, entity setup. Entity setup. Let's see. Finally, we've got entity setup. So I'm going to go over this quickly because I know that I'll go over it a little bit quickly. So you can say there's really 4 major ones, but some people say there's 3, but I just kind of listed 5. So you have your C Corp. Benefits are your flat tax rate. It didn't used to be that way, but now it's 21%. So you have this flat tax rate for a C Corp. Not a lot of entrepreneurs tend to start off as a C Corp just because they don't really have a reason to, or maybe they don't know that they should, if they should, so they just don't tend to. Then we also have an S Corp, right? Now, the benefit of an S Corp is that you get reasonable, S Corp requires you to pay what is called reasonable compensation. Now, the strategy for this, I'll talk about the strategy for this after I kind of go over the other 3. You have a sole proprietorship. If you're starting off in business and you're not a business that is going to be selling things that goes on the body or goes in the body, you might just try it as an S Corp. Like if you're just knitting, pillows, right? If you're not going to be selling anything that if somebody were to sue you, it would be an issue, you might try it as a sole proprietorship, do it for a year, see how you like it, then you can become an LLC. But if something is going on the body, in the body, or if you're providing some sort of services where there's a likelihood that people can come after you in the event you do something wrong, then I would recommend that you go ahead and do your LLC. If the business is yours and it's just your own, and you get your LLC, then that means you're single member LLC, which is going to get the same tax treatment as sole proprietor, which a lot of people don't know. So that's why I recommend, and a sole proprietor is all your stuff is going to show up, going to go flow onto the top of your 1040, flow onto your 1040 anyway. And then of course you have partnerships, which is great because you can just split profits, split expenses, kind of, sort of, and like there's some nebulous partnership rules. But I see a lot of people tend to either do an LLC and then follow S Corp treatment. Now, S Corp is great because what it allows you to do, for those of you that have S Corp, you already know this. What it allows you to do for your entrepreneurs is it allows you to take an additional, and this is not what the S Corp rules call it, but this is what it is. It's an additional expense from your profits. So normally you're like, oh, you have your income, you have your expenses, you have your profits, and then you pay whatever the IRS tells you to pay. Now, of course, during that time, you'll be making your Social Security, Medicare payments to the federal government, hopefully. If not, then set aside money to make it. But it allows you to take an additional expense from your profits, which is not what any of the other ones require you to do. And so it's called reasonable compensation. Now, that's the tax side. Legal side, please document what that reasonable compensation is. Because the IRS can come and be like, I'm going to audit you for, I don't know, because you fell into the score that they give you fell out of the band for one reason or the other. They audit you, they're going to obviously go after your deductions, right? Especially if it's large. Document reasonable compensation. Why is that important? Because if your compensation is not reasonable, it's now up to you to prove at the time that you did that transaction that compensation was reasonable. You cannot now, into the future be like, oh, IRS, this is why I said that was reasonable, if they audit you, 2 years down the line. So what do you want to do? You want to go online and Google reasonable compensation for whatever, position you're holding. So if you're a home healthcare owner, right?
I don't show the video.
Okay, I got it.
Okay, thank you.
Sorry.
because I can't do anything about it. So you want to Google what reasonable compensation is. You want to Google the average salary for that position. And you want to put it on paper. And I'm going to tell you some keywords to use. You want to put it on paper, and you want to have that paper that just says compensation structure for home healthcare owner, right? You're going to have the purpose, and in that purpose, you're going to state how often, a home healthcare owner is going to be paid. And you're going to include, I call other non-threatening, other non-threatening items. So state the purpose. And in addition to that, you want to document the method of determination. So you got title, purpose, method of determination. State, method of determination, use Google, Yahoo, whatever, list your source to come up with compensation for this position. Attach that to the back of this piece of paper, put on your company letterhead, make it look nice, and then put it in your file. All these things are in the case of an audit. You put it in your file. You don't need to give it to your tax person. You tell your tax person how much your compensation was. They file it. This is for you. Now, why am I saying this? Because I've been in corporate audits, and we see these things, and we see what things that you wouldn't necessarily think to document in the first place. I mean, who would think to document something that the IRS says you can already have, which is reasonable compensation? Why would you think to document it? Well, hey, you wouldn't. So that's why I'm telling you this. Okay. So these are just, so based off of what you want, right? If it's going in your body, on your body, you're going to want to do some sort of LLC structure. If it's not going in your body, on your body, and it's not in a situation where somebody can sue you in the event that you really mess something up, then sole proprietorship, right? Try it out for a year, see how you like it, and there you go. Partnership, if you have multiple partners, some people like to do the S Corp, some people just like to do the partnerships. I think it all depends on what they want to achieve out of it. So that's obviously a more nuanced explanation, but yes, okay. Any questions yet with regard to what we just covered before I go on? I'm just seeing if I see any hands. Okay, I don't see any hands.
I do have a question.
Okay, sorry, hold on. Let me make it possible for me to see your hand. Okay, yes.
Yeah, on the S Corp, those compensation, is it also individually taxable? Or is it an expense?
Is it
on the S Corp, the
two different
compensation,
Mhm.
is it individually taxable or is it an expense, the S Corp?
So it's going to, when you file your 1040, right? It's going to be, you're going to list that as income, right?
So you pay income on the individual side with that money.
Yeah, but then you also on your S Corp, and if you're S Corp, that's you can like right, you get your K1s. On the S Corp side, it's a deduction. Now, all that stuff from your K1 flows into your 1040. So it's going to wind up reducing. I mean, it's not gonna net zero, because on your individual, you're also getting your standardized deduction. So your standardized deduction is artificially lowering that compensation that you're getting from your S Corp. So it's gonna wind up being a bigger benefit to you. You know, if that makes any sense.
Okay.
Anyone? Yeah, so you're right. So in a sense, individually taxable, benefit, expense to the S Corp, but because it flows onto your 1040, you're going to then see an even further reduction to what your overall adjusted gross income is going to be. Yes, good?
Got it, yes.
Okay, fantastic. All right. So I want to go over these IRS red flags. And why do I want to go over this? Because if you know what the IRS is looking for, you guys are like, oh, she's always talking about the IRS. Yes, because when you sit in on these meetings and the IRS is hammering you or hammering your client, and you're just like, come on, you guys are really looking at this? And then the burden is down on your client to prove something. You're like, well, this is not going to happen again. So we're going to go over these red flags for entrepreneurs because I want them to avoid these red flags. Massive swings in income. If you're making, massive swings in income. Have a crooked taxpayer. If you have a taxpayer You know if they're crooked, there's a way to research them online. If they've been in trouble before your CPA. Now, you know they're crooked if when you get your return, you see a whole bunch of even numbers. That means they just guessed. Large refunds, foreign bank accounts, anything foreign. Your foreign banks are required to report, right? US people that have interest in their bank. And so they report that to the federal government. And so if you don't do the same thing on your return, guess who's coming after you? Foreign trust income. Foreign trust income, for some reason, is automatically kind of not, I don't want to say sketchy, but it can be because you don't really know what's going on with that trust. So those are just, it's not very common. Medical expenses, of course, that's on the individual side. Not reporting all of your income, you get a 1099, you got an IRA distribution early, didn't report it. I've seen this happen. People have not reported their early distribution. The IRS will find out. The same year, the person got a letter from the IRS, and they now, they're owing things like 30-something thousand. And I think it's either a reason that they forgot, but they just don't want to report it. So not reporting all of your income. So that includes your income from cryptocurrency. Now I'm just kind of bleeding into the individual side, but you're not reporting all of your income. At the same time, the IRS says you're technically supposed to take all your expenses and take all of your expenses, even though people don't necessarily tend to take all of them, especially if they're a single member LLC and they want to do things like buy a house, right? You got to show a certain amount of income. So that means some expenses you're not going to be taking. We talked about foreign accounts, mixing business and personal. I'm gonna go over that. Okay, what is the strategy for not mixing business and personal? Keeping business and personal expenses separate. How do you do that? Either get a credit card for your business or get a bank account for your business. Or be like, I don't want a credit card. I don't want to open up an extra bank account for my business. Then what you have to do is you have to make sure you keep a copy of every receipt and you document what kind of expenses that those receipts were. You can do this through a box called you can do this through an app called Shoebox. You can just take a picture of receipt and you're going about your day. I would recommend getting a separate credit card. It's easy to build business credit, which we're not going to go into today, but it's easy to build business credit, especially once you have an EIN. Now, if you're a sole proprietorship, you're not building business credit, let's be honest, because you have no EIN. But you get to build your business credit, and all those fees and stuff, they're tax deductions anyway for your business. So, I mean, why not? And it's clean and it's neat. You can print it out at the end of the year and you give it to your tax person. Remember, the IRS does nothing better than a messy taxpayer, and so we don't want any messy taxpayers. Making over is an extra zero missing. It's supposed to be 200,000, but making over 200,000. That's just the IRS has this score that they give each individual taxpayer, and people that make over 200,000 tend to get audited at a higher percentage. So you go from being audited at less than 1% to being audited now at 4%. And then of course, if you're making over $1 million, you get even audited even more, right? So anyhow, and then this is just some other ones: wrong social, missing information, computation errors. I don't know why people still do returns by hand, especially if they're sub 40, under 40, or if they don't use why they don't use a software. Give it to a CPA, use a software. People amend their returns. I would recommend that you don't amend your return. Like if you have to amend your return to get back more money, if you're getting back substantially more money, then have all your ducks in a row. If you're getting back a little bit more money, maybe I'll be not an issue. But if you're going to wind up paying more money, nobody's going to come. IRS is not going to say, let's see why you owe money this time and you didn't before. They don't tend to do that. But if you're getting back more money, then there will be somebody at the IRS that's going to make sure that that second return was done properly. Home office deduction. Now, the strategy for this is keeping pictures of your environment, because people tend to kind of abuse the home office deduction, overstate the square footage of their home, and all this other shenanigans. Keep a picture of your home. In the case of an audit, And the IRS is not going to go down audit line by line, like what business, they're going to like take the common ones that tend to be abused. And so home office deduction, just simply keep a picture of your environment, keep a picture of your space, and so on and so forth. Mileage, also abused because people overstate their mileage. Once again, if your mileage is in even numbers, right? If it's not 1,366 miles, or yeah, 1,332 miles, right? 132,000 miles. That's all even zeros. That's kind of like, well, you guessed, because how often does your odometer stop at 000? Once. So anything that has 000, just even zeros, it kind of shows that you guessed. And so that goes same for repeated numbers. Some people will have repeated numbers for advertising, the same expense that they had for maybe maybe they said advertising and car expense were the same number. Likely it wasn't. So, and then of course, if you've previously been audited before. Now, meals and entertainment. Some of us are going into tax season. What I would like you to do, for those of you who have not filed your return, is 2022 was the last year, and I did a video on this last year. 2022 was the last year for you to take advantage of the 100% deduction on meals as a business owner. Why? What do I even mean by that? It means that if you spent $10,000 last year on business meals, you can take all $10,000 as a deduction. Normally, you can only take half of that. So you can only take $5,000. So last year was the year. So go back, you've already given your stuff to your accountant. Look, go back and find some of those business meals that you may have overlooked and make sure you take it, because that was the last year to take a full 100% deduction on it. Really helpful deduction. This year, it's back to the 50%. So go ahead and take advantage of that 2022, that rule that ended in 2022. Now, some people tend to get audited because if they had a ton in meals expenses, but they really didn't show any income. Well, it depends on the other factors of your score. So it's not necessary that you substantiate it with the income, but just making you all aware. Okay, so let's talk strategy. Then we've gotten all the necessaries out of the way. And I want to go over, okay. Did I include this slide? Okay, so there's four things that I want to cover, and then I want you guys to, I want to take case studies. So I want people to just kind of say, hey, this is my business, or whatever it is, and then we can talk strategy as relates to your business. So we talked about documentation. With your tax person, they'll tell you to keep your receipts. But because I'm a lawyer, I'm going to tell you to put pen on paper. Because once you put pen on paper, why is that important? It shows profit motive. It shows that you're in the pursuit of profit. And the IRS is trying to ensure that your personal expenses are not flowing into your business expenses. But that's really what rich people are doing anyway. That's a whole different story. But they're trying to ensure that that's not what is happening. So in order for you to make sure that's not what is happening, make sure you document. Documentation is important. If you have children, I know some of you have children, and if you've hired them, fantastic. You pay them their money. You pay them their standard deduction. They get theirs tax-free. Everybody's happy. If you are a corporation, you gotta withhold payroll, right? You gotta withhold the payroll for your, gotta withhold payroll on your side. So that's a business expense anyway. But if you're a partnership, then you don't have to, right? If you're a partnership or an LLC, you don't have to withhold that payroll tax. So you get the full deduction, they get the money, everybody's happy. So, and then nonprofits, we spoke about this. I think I spoke about this. I did another video on this. Okay. Some of us, actually, let me say, most of us probably send money back home. And sometimes we may tend to send it as a family. So I know of a family that collectively they send money to different things. I'm going to use an example here in Houston. There's a foundation here in Houston. I won't say the name of the foundation. There's a foundation here in Houston. and they support widows in Nigeria. Now, those widows tend to come from the state that the mom comes from. Some may or may not be related to the mother, but they support widows in Nigeria. They send them money every month, right, through the foundation. Now, if you're doing this for your family members, going to support them, sending money to support them, it's may behoove you to get a tax benefit of that and incorporate a charitable entity, so a nonprofit. How does that work? So I like using things as examples. So you have you. This is you, right? You're sending money. This is you sending money home every month, money going out of your pocket. No tax benefit. But sending it back home. Now, you now decide, hey, I spoke to this tax person and they now told me that it would be a good idea to do charity, incorporate a charity. Now, make sure you're doing charitable purposes. Make sure you're not just sending money home for somebody to build you a house and then you're saying that's your charitable contribution. Don't do that. Let it be legitimate. Okay, so now you're like, okay, I spent about $20,000 sending money home to support people, whether going to school, building the borehole, different things. You spend about $20,000 a year. So you incorporate a foundation, or you incorporate a nonprofit. It can be a foundation, doesn't have to be. Incorporate a nonprofit. Do you file your 501c3, right? Get your EIN with the federal government. You file with the state as a nonprofit, and then you go on pay.gov, and then you get your 501c3 designation. You pay $275 or $245, I think it is, and then you're good to go. So guess what happens? $20,000 going out. Phew. No benefit to you, but because you have a foundation, here's your foundation. Your foundation also has expenses, right? So that $20,000, it's an expense to your foundation. Now, guess where these expenses are going, right? These expenses are now going to show up on your 1040 as a charitable contribution. And so depending on what your AGI limits are, or depending on your state, some states will kick the contribution back. They'll kick out the contribution. Texas doesn't, yay, because we don't have state tax. But that $20,000 that you spent every year now is a deduction for you on your 1040, right? And so that's why you see these charitable family foundations. It's not, they feel like being charitable. You see charitable family foundations where mom, dad, brother, sister contributing money every year for the foundation's purpose. Look, guys, it ain't because they just feel like being nice. They're also getting a tax write-off for that on their individual side. So let's not forget about nonprofits. Let me see if I have any hands before I go on. Okay, at this point, I wanted to interact with you guys and do individual strategies. This is individual strategy time. So number one, questions. And then number two, let's just talk. Okay, so that's pretty much it. Let's talk strategy for your particular business. So if there's anybody that would like to say, hey, here's my business, based off of what you've told me, I'm an entrepreneur based off of what you've told me, like, how does my strategy now look like? So if there's.
Right, before we do, thank you, Mfon, for this wonderful presentation. For those who might have joined late, this is a presentation on tax strategies for entrepreneurs brought to you by Clarity Tax Law Attorneys and Advisors. And the presenter is the lead attorney for that firm, Ms. Mfon Etukeren. If you have any questions, please either type them in the chat room or raise your hand, or you can ask it up front. But now is the time for questions. Thank you. There is a hand up, but you don't want to do more. Please unmute yourself and ask your question.
Okay, yes.
Good morning. Good morning.
Good morning. Good morning.
In fact, let me excuse me. Yeah, my question is, I have an LLC, right? I formed the LLC last year, but what I formed the LLC for I'm not going to be using it for that purpose specifically. I formed it initially for personal training, but now I'm switching it because I was able to purchase vehicles that I want to now use to rent.
I'm sorry. It's kind of hard to hear you for some reason.
Oh, no problem. Hold on. Let me switch. Okay, can you hear me now?
Oh yeah, much better.
I can hear you, yes.
Yeah, it was my speaker. Yeah, so I formed the LLC last year for personal training. I'm not doing the personal training at this point. I purchased vehicles so that I can use to rent and rent them out so I can make income off of. Do I have to form a new LLC to switch? I mean, do I have to form a new LLC for that purpose of business, or is it? Can I just leave it as it is?
So I'm going to answer you the right way. You don't have to form a new LLC. Here's what you should do. You have two different purposes. One was for personal training. The other, you're now renting. Two different purposes. Now, either way, because you didn't do anything with that first LLC, your second LLC, you've not registered. These are all Schedule C expenses. So what you just simply want to do is just make sure that on your Schedule C, you list your, you have your personal training business, but you didn't use it. Find a name for your rental car business. Who was asking to find a name for your rental car business, right? XYZ rental or whatever it is. And just make that a Schedule C. So you'll be operating as a sole proprietorship, which is one of the entity structures that we talked about, but you don't need to have a registration. And I recommend that in the first year, if you don't have anything that's going in the body, on the body, or you're not doing anything that would cause somebody to come back and sue you in the event that you did something wrong, go ahead and operate as a sole proprietorship. So that's just what you would do. So you don't have to mess with all that stuff. Just go ahead and follow your Schedule C, have your sole proprietorship for your rental business. You get the same thing. You get to list your income, your expenses. It's the same thing as other businesses, only it's just not registered. Does that answer your question?
Yes, that actually does. And I did have one more question, if that's okay.
Yes.
I'm
gonna charge you. No, I'm just kidding. I'm charging you new Naira.
At some point, I'll give you the money. Just let me get it first. Yeah, the other question was about the trust. And because I was thinking about it, I learned about trust about like a few months ago. I didn't have much knowledge on it, and I was questioning whether or not could I form LLCs under that trust, form an LLC, put the LLC underneath the trust, and I wasn't sure how that all correlated with, especially when it comes to like the tax benefits that come along with that, and also securing my own personal lifestyle and the lifestyle of my family along with that.
You missed the first 10 minutes or 15 minutes, right, of the presentation, I think.
Like, I was here, but I didn't understand.
Oh, okay, got it. I just didn't want to duplicate information if you had missed it. Okay, so the short answer is you can put an LLC in a trust, but it depends on what it's for. So, and honestly, everybody's trust looks very different. Everybody's trust looks completely different, but yes, you can put your LLC in a trust. Why wouldn't you want to put an LLC in a trust? When in the event that, let's just say, you pass, right? You're the owner of the LLC and you pass. If things need to keep happening in the LLC, like if there needs to be no break in operation, then, at least for the trust, I mean, you got to go through some steps. But if the LLC is not in the trust, then it can be, your partners I'm not saying your partners, the other owners of the LLC, if there's any owners of the LLC, you can kind of decide, okay, this is what we're going to do. This guy is gone. This is what we're going to do. But if it's in the trust now has to make that decision. And so there's just administrative steps that you have to go through. So, I mean, really, it just depends. But you can, in short.
Okay.
I'll probably give more information than was necessary, but what can you do?
Yeah, it's all helpful. I took my notes. Thank you.
You're welcome. Next question. Okay. If we don't have a next question, I want to, before I wait for you guys to have your questions, for those of you that are, how do we say it? For those of you that have businesses and you are not on social media, I would recommend that you get on social media. Now, why? Can we stop the recording? Itoro? Right. So if you're not on social media, go ahead and get on social media, put your business out there. This is, a great way to, of course, make more money, whether you want to make it through courses, utilize really the social media space to help you in your business, because you want to be able to show profit motive to the IRS. And so if you're advertising on social media, if you're offering courses, if you're offering different packages on your social media platform, it really goes to show that, hey, this is a legitimate business. Why it's not just a hobby. Why is it important to not be a hobby? Because you don't get benefits of being a hobby anymore. You used to, but not anymore. So you want to show that you're in this business for the cheese. So some people say, I'm in it for the cheese. So you're in it to make money. Okay. All right. Any other questions or anybody that would like to use their business and we could talk live strategy? No? Okay. Well, thank you all. That's really all I had for you. You can claritytax.com. You can just email me mfon@claritytaxlaw.com. Of course, you still put my number and my email in the chat, so you can just always reach out to me that way. And I just want to thank you for your time and thank you for your attention. So just feel free to reach out if you have any additional questions. I thought you're muted.
I'm sorry about that. Yes, but thank you very much, Mfon, for your wonderful presentation once again. And thanks to everyone who has joined. Again, this will be uploaded to our YouTube channel. I did paste Mfon's information, and for those who came late, I'm going to do it once again in the chat room. You can reach her at claritytaxlaw.com and then AKISAN@akisan.org. You can call her. Her email address is on there, mfon@claritylaw.com as well. We look forward to, again, more webinars like this. If you have any information that you think is useful to our general membership, please let me know so that we can arrange another presentation. So, thank you once again, and may God be with you. And for those of us following elections in Nigeria, let's pray for peaceful elections today. Thank you, and until we meet next time. Bye-bye.